George Schultze, founder and CEO of Schultze Asset Management. As we head into Q4, what is your outlook on markets?
Well, it's certainly been a choppy year with the sell-off in March and April of this year. And then, of course, we've had a great relief rally since then with fairly concentrated gains coming in the equity markets, but pretty strong equity markets. We had the Fed reduce interest rates during the month of September. Going forward, it's likely they'll reduce them again, probably this month, maybe next month. And then into next year, 2026, we'd expect the Fed to reduce rates again. So the markets are climbing. The macroeconomic environment certainly looks favorable, and earnings are growing, and lots of companies are doing quite well. So I do expect continued market gains through the end of this year and into next year. But one thing to be focused on and worried about actually is just concentration among certain large cap tech companies, the Mag 7 or the Mag 10, whatever you want to call them. Um, Lots of focus there. I read today that, those companies, their combined market capitalization represents about 40% of the gains so far we've had this year. So that's a little bit concerning, and it's certainly concerning for people interested in having diversified portfolios.
With that in mind, are there any event-driven sectors of performance that investors should be aware of?
Absolutely. The capital markets right now are wide open for transactions. There's an increasing amount of M&A. There's also, the debt capital markets are wide open as well for refinancing. And with interest rates having dropped a little bit, lots of companies are taking advantage of that. You've seen a lot of issuance of leveraged loans and bonds, junk bonds, as well as investment grade. But the key events that we're looking at here at Schultze Asset Management are companies that are over-levered, and as a result, they're forced to restructure their debt, whether it's in court or out of court. Companies like that are going into bankruptcy, or they're having defaults on their loan covenants and otherwise being forced to do distressed debt exchanges. So that's one set of events, companies faced with the risk of bankruptcy. On the other hand, there are certain companies that are just simply over levered. And again, whether it's through bankruptcy court or outside of bankruptcy court, they're often restructuring their debt, raising new money, perhaps by rights offerings or other vehicles, and generally looking to clean up their balance sheet so that they can get a new lease on life and proceed forward. So those are the main events we're focused on. One other thing I would say, Chris, is that for companies that previously restructured, that have clean balance sheets, some of those, and this is very interesting, some of those companies, if they're run by smart executives and smart boards of directors, they're taking steps, sort of self-help steps, to either buy back stock or pay special dividends to shareholders. Or in the worst case, if that doesn't work, sell the company entirely. If the company is just trading at so far of too much of a discount to fair value based on where the peers in that same industry trade. So those are the main events we're looking at. And in summary, I would say they provide some really interesting arbitrage profit opportunities.
So when it comes to bankruptcy and restructurings, how might investors act on that?
So I'll give you an example. One company that just completed its restructuring a couple of days ago is called Wolfspeed. This is a semiconductor company that restructured its debt through bankruptcy. It actually reduced its debt by about 70%. And what happened to the pre-petition shareholders in that bankruptcy is interesting. And it's actually sort of a good template and emblematic of what typically happens. In that case, shareholders were almost entirely diluted. The pre-petition shareholders, their stock was canceled. The old security was taken off the exchange, and it was replaced with a 3% ownership position in the newly restructured company. So that can be a great trade if you can find it, if you know what you're doing with this kind of thing, and if you can get the borrow. I wouldn't encourage retail investors to try to do this on their own, but if you can find that and if you have the expertise, that's a great trade. Short selling companies faced with the risk of inevitable bankruptcy and a potential restructuring scenario like that.
George, Excellent insights. Thank you for your time.
You're welcome. Have a great day, Chris.